Hey everyone, today we are diving straight into the world of finance to discuss a crucial topic, repo rate. So, what exactly is repo rate? Well, it's the interest rate at which central banks lend money to commercial banks for short-term periods. Think of it as the cost of borrowing for banks from the central bank. Now let's talk about how repo rate affects banks. The central bank raises the repo rate, it becomes more expensive for banks to borrow money. As a result, banks will increase the interest rates they offer on loans. This can impact their profit margins and lending practices. So now an obvious question comes that why you should care about it. Well, it directly affects your finances. When the central bank changes the repo rate, it can trickle down to the interest rate you pay on your loans like mortgages, car loans and personal loans. It can also impact the overall economy. To illustrate, let's consider a scenario. Imagine you have a fixed rate in mortgage at 4% interest and the central bank raises the repo rate. Banks facing higher borrowing costs may increase their lending rates. So when it's time to refinance your mortgage, you might find that the new rate is 5%, costing you more money over the long term. Now that we have covered what is repo rate and how it affects banks and individuals, let's delve into why central banks make changes to this crucial rate. Central banks have primarily many roles in the economy, but one of those many roles is controlling the inflation and supporting economic growth. Well, let's say the central bank raises the repo rate. So now banks have to increase the rate at which they lend loans to its customers. Why? Because central bank has already raised the repo rate. Now when customers will go to the bank and will ask the bank to give them loan, they will get the loan at a high interest rate. This will discourage many customers and the customers may try to cut their spending if they already have a loan. This will discourage the customers to decrease their spending, which in turn will lead to slower economic growth. On the flip side, if the economy is sluggish and unemployment is high, central banks might lower the repo rate. By doing so, they encourage banks to lend more money at lower interest rates, which can boost consumer spending, business investments, and job creation, ultimately stimulating economic growth.